David, great to see you. Is the Fed chair right to be concerned about global growth?
Well, in a word, absolutely. We have a really rapid slowing Chinese economy and an insolvency trajectory there as well. German industrial production is down 3 months in a row. It looks as though they're heading into a technical correction, and that's going to have knock-on effects throughout Europe. And Europe as an economic entity is larger than the U.S. is. So I've been saying this for a while. The OECD leading indicator, nobody talks about it, has been down 11 months in a row. It just by itself is forecasting a very weak global growth setting for the coming year. And as was mentioned several times in the FOMC minutes yesterday, that is certainly a principal downside risk for the U.S. economy in 2019.
David, I guess some of these concerns we've discussed with you for quite some time. The one that's newest is Europe in Q4, particularly in Germany and France. Do you think that's going to be a one-quarter only effect, whether it's because of German auto emission standards changing or the French protests, or do you think that is something that we can expect throughout 2019?
Well, the view among the consensus was that the third quarter was a one-quarter wonder. And now you've got the erosion into the fourth quarter. And a lot of the survey data and forward-looking indicators are telling you that it's going to remain very weak. I'm not going to sit here and say that Germany is going to go through 4 quarters of negative GDP. But the leading indicators are telling you that things in Europe are going to remain very soft, at least for the first half of the year. And don't forget that this is all happening at a time when the ECB has pulled the plug on quantitative easing. So they're not getting that incremental support, liquidity support from the ECB as it had done prior. And I think you're seeing, very clearly the impact of the slowdown in China, which is precipitous. Now you're seeing industrial activity there starting to contract, and that's having a big impact on the big manufacturing countries. And Germany accounts for about a third of the contribution to Eurozone industrial output. And there's going to be cascading effects throughout the global GDP, because Germany, after all, Germany is the 4th largest economy on the planet. And I think we learned from the last cycle that there's no such thing as global decoupling. There's just lags. So this, of course, along with some of the other impediments to growth in the U.S. that we can talk about, this is another major downside risk for the U.S. Exporting and manufacturing outlook for the next several quarters.
But we are not an export economy. I get your point. There's no such thing as decoupling. But this is why the president says repeatedly, we are the envy of the world in terms of growth. Everybody else is slowing. Exports are what, 10% of our GDP? In Germany, it's like 40%. We're not as exposed to global growth slowing as the rest of the world.
Well, I would agree with you on that. The U.S. is a large closed economy, but it's just another extra set of basis points of downside risk. And don't forget that there's other knock-on effects through the industrial sector as exporters start to cut back on spending and on job creation. You can't just look at it, Sarah, as a static development. It's more dynamic, and there's going to be domino effects through the rest of the economy. The other thing you got to keep in mind here, because I know everybody talks about how, Jay Powell says the economy is solid. Well, what else is he going to say? He just raised rates on December 19th in the middle of a market maelstrom. What else is he going to say? He can't say in a matter of 3 weeks, oh, the economy is rolling over. As a politician, he has to say that. But I am seeing evidence of decay. And the only thing holding the U.S. economy together in the past several months has been the consumer. And yet, when I looked at the JOLTS data that came out the other day, you are seeing in the retail sector a big decline in hiring intentions and a big decline in job openings. The Challenger numbers for December showed that in the retail sector, layoff announcements are up 30% from where they were a year ago. So the consumer has really kept the glue together. The rest of the economy is almost stagnant, by the way. So the key is really going to be the outlook for consumer spending, and I think that that's really going to be at risk in the next 12 months, alongside everything else that we've been talking about.